Okay, go ahead.
Okay, this is Mark Taylor, the City Treasurer, and I'm calling to order the January 25th, 2021 meeting of the Investment Advisory Committee. So first off, I'll do roll call. So Steve Knobloch.
Here.
Art Carter. Art Carter's not here. Al Sondag.
Here.
Art Carter is in the meeting. It's *6 to unmute. I think he might just be muted.
Okay. Bill Blackwell.
Okay, I'm unmuted.
Oh, Art Carter's here. Gotcha.
Yeah.
Good to hear you, Art.
Thank you. I'm sorry. All right. Where were we?
Okay. Is
going.
Bill there?
No, I do not see Bill.
Okay. All right. Very good. And Erickson from the city is here, as well as Courtney Farrell. And Jason Schmidt is here from Chandler. Welcome, Jason. Okay, so first on the agenda is the approval of the minutes from the October 26th meeting. Are there any changes or clarifications to the minutes as presented? Okay.
I didn't see any, so I would move to approve as presented.
Okay.
Yeah, you need a second.
Do I have a second? Okay, that's a second. All in favor?
Aye.
Aye.
I'm going to abstain in as much as I wasn't involved in the last meeting. So
Okay. So, so we got approval from Art and Al, and I will say aye. And any opposed? Okay. The minutes are approved as presented. Okay, before we go into the investment report, I just want to break here for just a minute and formally welcome Steve Knobloch to the Investment Advisory Committee as a council representative. Steve, welcome. It's great to have you here. And if you could just give us a little background about yourself and how you got the short straw and were picked to be on the Investment Advisory Committee.
okay, thank you, Mark. Again, Steve Knobloch. I was just elected in November to the short term on the city council to fill the remaining 2 years of Dan Bain's term. I was on the council about 15 years ago when Stephanie Dory left the council. I won a special election to fill her spot. I've been in San Clemente about 20 years. I'm from Orange County by way of the East Coast. I was a staff person at the Board of Supervisors back in the 70s. And after college and law school, I worked in the title and escrow industry. I worked for Chicago and Fidelity Title and was a national commercial underwriter, a national advisory claims counsel, and was the law firm liaison for the company, placing $150 million in litigation fees with national law firms nationwide. And more recently, I worked as an in-house counsel with the Craig Realty Group that built the outlets in here in San Clemente. And they've got about 15 outlets in the nationwide, a bunch of restaurants and a host of other businesses. And I recently, last year, retired from the Craig Realty Group. And when the vacancy occurred, I decided to run and was fortunate enough to be elected. So here I am. I don't consider myself a financial expert, but I can balance my checkbook and know what basis points are. I spent about 4 or 5 years of my career in banking in San Diego for Great American Bank. I was there on their legal team and was in their special asset management department, taking over or working out large troubled loans. So I'm delighted to be here. I look forward to working with you folks. and I'll contribute what I can, and hopefully I won't be an impediment to the fine work that you all have been doing.
Great.
So,
Thank you, Steve. And again, welcome.
Thank you, Mark.
Okay. On to item 3, the investment report for the second quarter fiscal year. So, Jason, if you could start us off and take us through the first part, and then I'll take over for the internal portion.
Sure. So let me share my screen here real quick. Hope you have to enable me to share my screen.
Either that or Courtney,
Okay,
or
it can do either way. I just allowed you. Let me know if that works.
That works.
Ooh, this is good.
All right. Can everybody see my screen?
Yes.
yes.
Perfect. Perfect. So let's talk a little bit about what's been going on with the economy. So I'm going to start off here with an economic update. I think everybody in this room kind of knows what's going on here. Really, it's the path of COVID that is really affecting the economy as far as the largest factor. With Al saying he just got his vaccine, he's living proof that there's vaccines out there and people are getting vaccinated. So definitely that's going to have a positive impact as we continue to move forward. The question still is out there is how long is it going to take for the majority of the populace in order to get vaccinated for this. So we'll have to see kind of how that moves along. We did have Congress pass another $900 billion stimulus package. I'll go over that a little bit later in detail as far as where those funds are going, but definitely that's going to help boost the economy and also is going to give us more stimulus into this economy over the last 12 months. It's around $3.6 trillion, which is an enormous amount of money relative to about a $20 trillion economy. With that in mind, the Federal Open Market Committee met in December. They'll actually meet this week also. But they really affirmed their continuous guidance, and essentially they're going to continue to buy Treasury and agency mortgage-backed securities into their portfolio at the amount of $80 billion for U.S. Treasury and around $40 billion for agency mortgage securities. And so when you kind of take that math and look at that, that's about $1.4 trillion that they'll be purchasing of securities onto their balance sheet as they continue down this path. They did not indicate whatsoever that they were to trail those different purchases. There have been other Fed governors that have been talking about that here or there, but nothing from the committee itself. And also with that, they continue to affirm their zero bound, essentially, with the federal funds rates between 0 and 0.25% over this period of time. The Treasury yields, this is back in December, the commentary below there, but more recently what we've been seeing is that shorter term rates have remained relatively stable as the Federal Reserve keeps the things pegged at the zero bound. As you go further out the yield curve, I'll show you a little bit later, you continue to see where rates are coming up a little bit, I would say, from where they were, from where their historic lows, but still relative to a historical basis at relatively low levels. In fact, there was a lot of cheer that went on when the 10-year Treasury note went above 1%, depending upon what side of that trade that you were on. But remember, not too long ago, 1% of the Treasury would have been unheard of, and we're seeing that as a cheering point for some. As we move on to page 4, you can see this is looking at the stimulus package. So in the chart above, you can see the different packages that have already been passed. So we have the CARES Act, that was about $2.2 trillion. We have the coronavirus relief bill, which was about $0.5 trillion or $500 billion. And then we have the phase 4 stimulus, which was the more recent one, which is $908 billion. Add those all together so far, $3.6 trillion. They're talking about another package that's supposed to be bigger than the previous package. Most indications that I've heard is they probably won't get anything done there until March. And we'll have to see what happens there with related to that. But still, $3.6 trillion into a $20 trillion economy in less than 12 months, that's a large sum of money. The graph on the left-hand side is really showing you where the $908 billion is going. So approximately $337 billion is going to businesses. This is through the payroll protection program, small businesses, and also farms and ranchers. Then you have individuals through enhanced unemployment benefits and other types of benefits are getting approximately $286 billion. Schools are getting $82 billion. Vaccinations, $68 billion. And then you have the safety net, childcare, things like that. You're getting at $48 billion. Transportation, $45 billion. If anybody's wondering how John Wayne Airport is keeping itself abreast or afloat right now, it's all about CARES Act money. Remember that they got CARES Act money. Now they're going to get this money. That's really how they've been kind of filling that hole, considering that most revenues at airports are below 50% of what they were a year ago. And so it's definitely a place where you're seeing that. And then also you see some other things, $42 billion going to clean energy and also maybe some broadband development, maybe in some areas that don't have that. So this is what we're looking at as far as fiscal stimulus. And we did put in the title of this, 3.6 trillion and counting, because chances are we will see more money that's going to come in the form of these emergency stimulus bills. Here you can see on page 5, the employment rate. So the green line there is the non-farm payrolls. The dashed line there is the 3-month moving average. It's really the kind of the same story that you're going to see as we move along through this. Really, we had the lows in March, and we're continuing to expand in the economy, and with that, payrolls are expanding. Things got a little bit weaker here over the last couple of months as infections of the coronavirus increased, and you had some more additional lockdown provisions or where local authorities have had to put restrictions. So you had some things that are locked down. Thus, you had some higher or lower employment recovery that went on. When you look on the right-hand side, the green line there is the unemployment rate. The dashed line there is the underemployment rate. You can see that those have kind of leveled off, but definitely at their lower levels. Again, the labor market's was weaker over the last couple of months, but as we continue to administer the vaccines and as things continue to kind of reopen, we'll continue to see where these start to make improvements once again. Here you can see page 6 is initial jobless claims. This was a really good measure when we were looking back, especially at the beginning. Now it's becoming a little bit more stale, but still has some good information. On the very bottom there, you can see the green bar graphs are those weekly initial jobless claims. Remember that those are folks that have filed for unemployment insurance. And so at the height, it was millions. When we were looking at it. Now it's started to come down, 787,000 as of January 1st, 2021. And then you can see continuing claims in the green there. And so you can see in the gray line, you can see that that's come down from 9.3 billion back in October, all the way down to about 5 million today. These numbers are there's lots of various programs and things that are going on. So there is some discrepancies and things, what we would have called unemployment before versus what we call it today. But I think the common theme is that it continues to get better. It's just that we are not below pre-pandemic levels today. Here's page 7. So on the left-hand side here, looking at inflation, this is the broadest measure, CPI. The green line there is year-over-year changes of the headline number. The dashed line there is year-over-year changes in the core number. And what you can see here is that inflation has definitely come off the lows that we saw back during the height of the coronavirus pandemic. And now what we're really seeing is those inflation rates came up a little bit, but have leveled off. Then on the right-hand side, the Fed's preferred measure of inflation, personal consumption expenditures. You can see the green line there is the headline. The dashed line there is the core. Remember, X, food and energy, those tend to be pretty much volatile components. And you can see they're below that 2% mark that the Fed has called its target in the past. So inflation, there is some expectations that are building in the market, I would say, but they're still on the back burner relative to Fed policy and things like that. So I do not think, at least in the near term here, that we're going to see the Fed react to these inflation rates. Maybe later on this year, as we continue to see how this fiscal stimulus is really coming into the economy and whether it is actually inflationary this time. We'll have to see what happens there. But at this point, we don't see a big increase in inflation that's coming real soon here. Here you can go on page 8. So if you look at the left-hand side here, this is looking at GDP. This is a chart. This is the quarterly changes. If I go to the very bottom of that chart, what you can see is that in the fourth quarter, it was 2.4%. In the first quarter, it was -5%. And then we get to the second quarter and the third quarter of 2020. And you can see down 31% and right back up to 33.4%. I really think that those numbers, they don't give you a really good sense of kind of what went on throughout the year. I like to look at the year-over-year changes a little bit more smooth, especially in this environment. So on the right-hand side, you can see that maroon line there, and that's really the year-over-year change in GDP. We are getting the first look at our fourth quarter number this week, and so we'll see how that comes in. Typically, we think that GDP is going to come down between 3 to 5% this year. And so that's not a good thing. We don't usually register year-over-year changes in that negative area, but it's not as bad as some of these quarterly numbers portray it. And also 2021, if expectations are met, is shaping up to be a pretty good year at growth rates between 3 and 5%, depending upon what estimates that you look at.
Jason, can I just jump in here?
Sure.
Going back to inflation, you don't have to scroll back up there, but where does Chandler see that going with all the stimulus? I mean, do you see that starting to come into the system and having a meaningful impact on inflation or not?
So what we're really looking at, Mark, is looking at really the personal savings rate. And so really that is ballooned. I mean, we're now about 12%. If we would start to see that decline materially and get back to our average levels, which is basically 6%, definitely we think that inflation would probably take place faster. But you have to have two things in place, as we learned in 08-09. Not only do you have to have the stimulus in place, but you have to have the velocity of money, i.e. is that money being spent into the economy, if that moving forward. We are seeing all the monetary aggregate numbers, M1, M2, really balloon up. It's just a matter of whether consumers are going to be there to spend that money. And to this point, it's been compromised by the restrictions that we have today. Our viewpoint is that, yes, we are going to start to see inflation expectations build. We don't think it's going to be something like Argentina, where you would see 10, 20, or 30%, but definitely you could see that start to bump well above their 2% range, maybe 2.5%, 3%, something like that. And that definitely would put pressure on rates moving forward. The only wild card there is the Federal Reserve has been in place, and the Federal Reserve continues when rates start to go high to talk about yield curve control and also to talk about additional purchases. The other thing to remember is now Janet Yellen is now Secretary of Treasury, and along with that you have Jerome Powell. And remember that Janet Yellen was part of the Federal Reserve. So one of the things that I think is a theme is that the Treasury and the Federal Reserve are working more in tandem than they ever have before. And so in some ways that's a good thing. In some ways, as my own personal viewpoint, is that the Federal Reserve is supposed to be an independent agency. And at this point, they're becoming more in line with the Treasury. So hopefully we see where that doesn't go too far. But at this point, in order for the Treasury to continue to finance deficits at the levels that they have, rates probably are going to have to stay low, even if you were to start to see increased levels of inflation.
Yep. Thank you.
All right. So I'm going to move and I'm going to talk about the consolidated portfolio. Remember that this is the Chandler managed portfolio and also the internally managed portfolio. So some assets are managed by Chandler Asset Management. Other assets are managed internally, such as liquidity and things like that. So when I look at the December 31st, I'm just going to take the portfolio versus that of its benchmark. I'm going to just look at the portfolio average maturity, which is the middle line there. So the average maturity of the portfolio is 1.41 years. The average duration, remember duration is the portfolio sensitivity to interest rates. The higher that level, the higher the sensitivity, the lower that level, the lesser the sensitivity. That's 1.28. The average purchase yield, 1.39. It's gone down from 1.51. A couple of things that are happening there. One, reinvestment rates, meaning as we've had to reinvest securities into a lower interest rate environment, that has definitely dragged that down. In addition to that, the city holds a portion of its assets in LAIF, which is the Local Agency Investment Fund. Think of it as like a money market fund for municipalities up and down California. It's a very large pool, 20, 30, $40 billion being managed by the state. That rate is also coming down. So that rate now is around 44 basis points to most current reading and dropping. Chances are that rate's going to get down to around 20 basis points, I would think probably within the next 3 months or so. The average market yield is 31 basis points. It's a AA plus rated portfolio, and the portfolio is about $149 million. Here you can see the purchase yield to maturity of the portfolio. And you can see that back in July is 1.65. That has gradually come down, as we spoke about before, those driving factors there of reinvestments and also the local agency investment funds yields coming down at the same time. But by purchasing longer term securities, we definitely locked in some of those higher rates. Given if you had placed all your money in a money market fund today, you'd be lucky to earn 5 basis points on that. So definitely by having a longer term strategy, you're definitely improved the investment portfolio earnings. Here you have looking at portfolio earnings. This is looking at the fiscal year Q2. And so you can see the gray line there is as of 2019. The green line there is as of December 2020. And you can see that's gone down there about $190,000. That's those lower interest rates that we've shown you in the past. And also you can see the fiscal year to date, 1.4 million approximately, last year, this year about 1.1 million. So down around $300,000 for some of the reasons that we spoke about before. Here you can see page 13 looks at the portfolio characteristics. So the bottom graph there shows you both those different characteristics in the different sectors. And what I consider sectors are treasuries, agencies, corporates, those types of securities, so on and so forth. So the green line there is as of December. The gray line down on the bottom bar graph is as of September. So you can see the changes there on a visual basis. And then if you look up towards the top, you can see actually the table of that to see the actual numbers there. And so what you've seen is that, I'm just going to point out some major changes here. So you can see that there's been a reduction in treasury securities. You can see that there's been a reduction in money market securities. We've added some assets into agency securities. These are the senior securities of Fannie Mae, Freddie Mac, Federal Home Loan Bank, Federal Fund Credit, so on and so forth. And then you can also see LAIF had a contribution or increase that to about $10.5 million. The reason why you see LAIF increasing from that standpoint is that property tax and things like that gets paid at this period of time. So a major revenue source for the city. The city continues on getting revenues now until about April or May, and then that drops off. And so you're going to start to see the portfolio build up a little bit just because in general, you're going to have cash flows into the portfolio. Some of that's going to go into LAIF because it will be spent later. Then you can see page 14. Here you can see the consolidated portfolio. You can see we're using all the different tools in our toolbox. I'm not going to point out every individual one here. I'm just going to point to you and say about 39% of the portfolio is in U.S. agencies, about 17% is in U.S. treasuries. Add those two together, about 57% of the portfolio is what I would call in government securities. And then we have other securities such as corporate bonds and things like that make up the rest of the portfolio there. You can see page 15. Here you can see by different industries. So you can see, that government securities, like I said before, about 57% of the portfolio. Then you can see the other industries that are part of that, banking being, kind of the highest one there, about 4%. Technology being about 2%. And then pooled investments, meaning LAIF and things like that, make up about 31% of the portfolio at this point. And then you can see that also. Here we remove the government securities from that, so it doesn't look as distorted, and also the pool securities. So you're looking at just the corporates on the industry standpoint. So banking makes up a big percentage of that. Also looking at technology and electronics also makes up a big percentage of that portion of that. Banking has always made up a big percentage of the portfolio. It makes up a big part of the issuance that's issued of corporate securities between 0 and 5 years that are in place. And so that's always happened that way. Technology companies are very highly rated as far as their overall balance sheets. So that also makes sense that those are a bigger portion of the portfolio because those securities are available and we're looking for high quality securities. Then you can look at page 17. Here you can see a quality distribution. This is on an S&P scale. You can see that everything is rated A or better. Any of the not rated securities are either rated by Moody's and or S&P.
Jason,
yes.
if I could interrupt you in that last slide, I was on mute. I couldn't catch you before you switched the slide.
No worries.
You mentioned 31%. I'm trying to find. You mentioned that with 31%. Was it with Lakes?
Oh, it was back here, and that is really with pooled investments. So that was the 31%.
Oh, okay. So that's for okay.
So that's investment pools. So that would be LAIF, things like that would be included in that. And majority of that's going to be LAIF.
Okay. Okay, thank you.
Uh-huh.
I was following it, but I missed that and was looking for it. And went
Oh,
by.
no worries.
Thank you for showing.
No worries. And then, so just moving on here, you can see the ratings distribution. Here you can see the duration distribution, basically it's like a maturity distribution. You can see the majority of the assets held by the city are in that very short-term portion, 1 year and in. You're looking at approximately 50% of the assets are there. And then when you look on a longer-term basis, is you're seeing where the assets, have some longer-term perspective. But in general, you'll see that that's the case there. And then looking at the duration distribution here you can see that, and this is not including LAIF and cash. And so here you can see basically where things are at as far as looking at the percentages without the cash. So you can see that it's much more diversified across when you look at those specific things. If I can get my...
Jason, let me stop you there for just a second.
Sure.
I mean, I'm assuming though you are managing the portion, the Chandler portion, to the strategy, even though 2-year treasuries are paying next to nothing, and as are almost all treasuries, and agencies obviously are some premium above that. But are you dealing with that in any particular way, or just saying this is the environment we're in, and we're just going to invest the money as we're supposed to?
So in general, how we've really tried to deal with that is really tried to change the structure of the portfolio at the same time. And so in some ways, what you'll see us look at is as you saw previously, we are starting to purchase more agencies and less treasuries into the portfolio. We actually had a decent amount of issuance by Fannie Mae and Freddie Mac in the second quarter. That has since, in the fourth quarter, that has since dried up, meaning that Fannie and Freddie have not issued securities probably since December. And they've actually passed on a couple of slots that they had to have securities. In general, we continue on with our strategy, because at the end of the day, when we look at it, the strategy, and we continue to do this for the city for a long period of time, has really played out and the ability to do that. And if I think back to 08, 09, the Federal Reserve was on hold for probably 8 or 9 years, if my math is correct. And so really, I think it's very hard to tell when they're going to actually move. One of the things we are a little concerned about is potentially, as we've spoken about before, is a steepening of the yield curve. The other thing that we've been looking at is just credit spreads. Credit spreads remain really tight today. And so we haven't necessarily been a big taker right now of putting more money to work in credit. And so in the future, we would probably start to mitigate some of this effect of low rates by having more securities or potentially more purchases in credit. And but at this point, we have not done so because the opportunity is not there. So as from a duration perspective, we continue to buy different types of securities. Typically, we're buying longer than 2 years. We're going to buy probably 3, 4, maybe even potentially 5 years out, just because the yield curve is steeper there, and we'll roll down that yield curve, but still keep our duration in line with what the strategy is.
Thank you.
And then you can see here's total returns. So this has a lot of information on it. So the table below, the first line is the Chandler managed portfolio. Then you have the internally managed portfolio. Remember, the internally managed portfolio is typically going to be shorter than the Chandler portfolio. So it's not going to line up real well with the benchmark, but we think it's still good to show that. Remember, it's going to have LAIF, it's going to have shorter term securities. And then you have the consolidated portfolio. And then you can see the benchmarks. You have the 1 to 3 year US Treasury benchmark. You have the 1 to 3 year US Treasury and corporate benchmark. And that would be A-rated securities or better, or AAA to A. And then you have the 0 to 5 year index, which is really our index today that we've been following. That is something that the committee decided to do. Geez, how long ago was that? 9/30 of 2019 is when we actually implemented that. So right before we really saw a big decline in interest rates. So good timing on the committee's part for adopting that. And then you can see right above there, you can see it in a bar graph basis. I'm really going to go through the table down below and look at the Chandler managed portfolio. So over the last 3 months, earned 13 basis points. Over the last 12 months, 3.69%. Remember, this is in a portfolio that has an average maturity of less than 2 years. And then also since inception, 1.78. If you look at the internally managed portfolio, those numbers are a little bit less than that, that's because it's a shorter portfolio. And then when you can consolidate both of them together, you end up getting 0.13 for 3 months, 2.81 for 12 months, and 1.48 for since inception. And then if you look at the benchmarks below that, you can see that the Chandler managed portfolio, which is really more directly managed to that particular benchmark, is exceeding that of all the benchmarks below that over those periods of time. And so the portfolio continues to perform well. It continues to do well as far as safety, liquidity, and yield. And so really achieving the goals of the city that it's set forth. And then you can see page 21, you can see it on a net of fees basis. So you can still see that information. So that's the Chandler managed portfolio on a net of fee basis. And even on a net of fee basis, the Chandler portfolio is equal to, if not exceeding, those benchmarks below. Then we're looking at yield comparisons. So you can see different types of securities. So you can see a 3-month treasury bill, a 6-month treasury bill. You can see LAIF at that period of time. This is as of December 30. It was at 52 basis points. Since that period of time, in the last, 26 days, 25 days, it's gone down to 44 basis points. So that gives you kind of an indication of how much LAIF, the yield on LAIF is falling. You can see commercial paper is 12 basis points. A government money market fund pays you 3 basis points, and your purchase yield to maturity is 1.39%. I can remember reporting to this committee when we had an inverted yield curve, where actually the yields on shorter term securities were higher than that of the portfolio. But by keeping that strategy and continue to keep that strategy going, this ebbs and flows over time, but it will all be calculated or all be captured in that total return of your portfolio. Then you can see page 23. This is looking at the yield curve as of 9/30. This is U.S. Treasury yield curve, and as of December 31st. And so you can see the gray line there is as of September 30. The green line is as of December 31st. One of the things to look at here is if you look at the yield curve and you go from 3 months out to 2 years, there is no curve. It's really almost non-existent. As you go beyond 2 years, that curve starts to shape up and you start to get at least a shape of that curve. So that's really, if you think about it, the Fed has a pretty good control over short-term interest rates out probably to 2 years. Once you get beyond that, other factors start to come into play. Inflation, supply, demand, and things like that.
What are the two lines? What do they represent? Which
2 different dates. So the gray line is as of September 30, and the green line is as December 31st, 2020.
Oh, okay, thank you.
And then you can see page 24 is compliance. This is an important page. Your portfolio fully complies with the investment policy. And so Councilmember Knobloch, I know that you recently voted on the investment policy. We take it very serious. So we have a compliance system that looks at trades not only on a pre-trade basis, also on a post-trade basis, and we supply you with a report, because at the end of the day, this is how the council is telling us how to manage the portfolio, basically the rules around that. And so this is tested not through just an electronic means, but also we have a whole department that is dedicated towards compliance.
And I appreciate you being available to address that. It was a long meeting and we kind of moved through that pretty quick, but I think Mark did a pretty good job of addressing all of that.
Yeah.
Thank you.
And then page 25, this is really Consolidated Holdings. And so looking at page 26, this is a Consolidated Portfolio. So this is showing you basically every different issuer that we have in the portfolio. And so this is really diversification. And so you can see that the majority of the investments are in LAIF and or U.S. Treasury agency securities. And then as you go down from there, our largest allocation is to U.S. Bank Corp at 74 basis points, less than 1%. And as you continue to go on down there, you can see the different percentages that are there and what's owned there. Some of the banks and credit unions you may not recognize. Just recognize that those securities are either $250,000 or less. So they carry the full insurance of the FDIC for timely payment of interest and principal. And in page 27, you can see the different holdings that we have. And then this is a maturity schedule. Remember, one of our tasks is liquidity. to ensure that there's enough liquidity in the portfolio. And so this goes out from the first maturity, which is essentially some of these money market funds and things like that. We assume that your money is there overnight. You can get that the same day. And then it goes all the way out to the last maturity that we have, which is July 21st of 2025.
Okay.
Here you can see some of the transactions that we've made. Here's some of the maturities and some of the contributions withdrawals of late.
Yeah, my screen is I've got everything on a little window and I can't read anything here. See if I can open this up.
Steve, the packet that you received that had the minutes, if you keep going down on that file, it has this whole report on there.
Right. Okay. My computer just shrunk on me here, the screen, so I having trouble following. And I have not opened to the other anything else. I'm just following Jason's.
Okay. So this concludes kind of the primary report. And Mark, I'm wondering if you want me to go through the Chandler managed portfolio alone, or is that something that you'd like just the committee to look on their
No,
own?
go ahead. Take us to the Chandler portion and I'll handle the internal portion.
Great. And so again, the objectives here are safety, liquidity, and yield. Our benchmark is the 1 to 3 or U.S. Treasury agency, and we buy high quality securities that conform with your investment policy. Here you can see the Chandler managed portfolio. This is as of December 31st. So you can see the average maturity on this portfolio versus its benchmark. So the average maturity is 2.14 versus the benchmark, which was 2.24. You can see the average duration 2.04 versus 2.18. So a little bit short the benchmark coming into year end. We also did see a little bit of an increase in January, so took advantage of that in the portfolio. Here you can see the average purchase yield is 1.78%. The average market yield is 22 basis points. It's a AA plus portfolio, and it's approximately $82 million.
So let me just interject here for Steve's benefit. So when we look, Steve, at this, that middle column, the average maturity and duration, we expect this to conform much more closely to the benchmark when compared to, say, the consolidated, or certainly even less so the internally managed, because Chandler is managing to a specific strategy, and so that's why we expect them to conform much more closely to the benchmark, whereas the internal portfolio, we just have a lot of money in LAIF, and I'll talk more about that later, but I just wanted to point that out.
Thank you.
Art, I can see
Hey,
you.
Art.
What?
I said I can see you now.
Yes, you can.
Looking
I
at
was
the
finally
next
getting
page.
permission.
Looking at the next page, it gives you a similar page that we looked at on the consolidated portfolio, basically showing you where the changes have been made as far as the overall market values from 9/30 to 12/31, and where you're seeing additions into the portfolio. And again, here's a similar theme. Basically, from the money market fund and U.S. Treasuries, we bought more agency securities. We have done very little in the form of credit at this point. Again, credit spreads have been tight for a lot of different reasons. Some of that being intervention early on by the Federal Reserve. In addition to that, this global hunt for yield, which is back again, and really that's tightening up credit spreads across the spectrum. And then you can see definitely on the bottom there, you can see the graph, the different bar graphs there, and those changes also. Page 48, you can see the different sector allocations here. Again, you can see that treasuries and agencies make up around 77% of the portfolio. And you can see the other types of securities in the portfolio over that period of time. Here you can see on page 49, you can see the different corporates, not much of a change there. You can just see different percentages now because the Chandler managed portfolio from a market value perspective is smaller than the consolidated portfolio. And then you can see the duration distribution. Here you can see your portfolio is in the green in the green as of December and the gray as of September. And so you can see that we are continuing to have a very well diversified as far as looking at the maturity buckets, with the majority kind of our biggest buckets here being in that 1 to 2 and 2 to 3 year range, which makes sense. You know, we have a 0 to 5 year benchmark, but the majority of that is in that 2 year bucket. Art, you had a question.
Yeah, I no longer have a little hand that I can throw up. So Royal Bank of Canada, is that actually Canadian or is that domestic?
That is actually a Yankee bond. And so under
Okay, very good.
California government code, that is permitted because they have branches in the United States. So they have a banking license in the United States.
Yes, they do. And I believe they have a charter for California too. Okay. All right, thank you. Sorry.
No worries. And then page 51 shows you compliance. This is looking at compliance of just the Chandler managed portfolio. And then Mark, if you want to talk a little bit about page 52, which is the internally managed portfolio, and I can move the pages for you if you'd like.
Great. Yeah. Okay. So we'll just go to page 53. So you can see that the internally managed portfolio has a much shorter average maturity and duration. And Steve, for your benefit, the LAIF, Local Agency Investment Fund, that the duration on that is actually counted as 0. So it's basically liquid. In reality, they're investing in securities that have maturities. Well, Jason, maybe you could chime in here. What's the average maturity duration of LAIF right now? Just ballpark,
So about 190 days is their average maturity.
Right. So in reality, you could say the biggest part of the internally managed portfolio, although it's counted as a 0 duration, has 190-day plus maturity or duration. So in any case, that's why there's such a decline, and you can see it from September 30th. The average maturity went from 0.66 to 0.52, and a similar decline in duration from 0.5 to 0.36. Average purchase yield went down roughly about 18 or 17 basis points, I should say, and average market yield went down about 3 basis points. You could see the market value went up, and that was in large part the inflow of property taxes into the portfolio. If you switch to page 54, Jason, here you could see the changes in the far right-hand column. So treasuries went down by about 2 million, as did money market by 3 million, and all of it, along with surplus receipts, were put into LAIF. That's a nice place. It's a nice tool to have or a nice arrow, I should say, to have in the quiver. In that, as Jason pointed out, is paying right now about 44 basis points, whereas a 2-year treasury is paying 12 basis points. So, the danger is eventually, as it comes down, maybe 20 basis points or below, there may have been an opportunity to invest in some longer term, say, agency or even CDs. And so we're bypassing that, and potentially, LAIF could go down a lot lower. Whether it will or not, time will tell. But in any case, that's where I've been putting the money as so not only the receipt of property taxes and other revenues that the city doesn't need for operating expenses or capital projects, but also as treasury securities and agency securities have matured, I put those into LAIF also. Now, per the investment policy, actually by state statute, we're limited to $65 million in LAIF. But the investment committee has further limited that to 50% of the portfolio. So right now that's not an issue, but potentially we could hit bump up against the 50% limitation before the 65 million. I don't
Mark?
anticipate
Mark,
that.
yeah, Mark, I'm just wondering the 60 million, I'm just curious why that's not in longer term. Is it because from budget reasons we need a chunk, the majority of that 60 million for operations over a 6-month period?
Right. So Leif has daily liquidity, Steve. So we can, as long as I think we get in the request by, I think it's 9 or 10 a.m., that'll be in the checking account later that day.
No, I understand. My question is, why would that 60 be in longer term investments to get more yield? Is it, and I don't, I'm just guessing at the answer. Maybe you could tell me. Is that because we need that liquidity for that larger liquidity for operating?
No, we don't need the liquidity. It's just that Leif is paying a higher yield than longer term securities.
So that is the better investment.
It is the better place. Potentially, though, as Jason pointed out, Leif went from was it 54? It's down to 44 basis points since the beginning of the year, but it was up over 50 basis points at year end. So it's going to come down as the securities in his portfolio mature.
I thought I saw some larger returns for the longer term investments. Was I mistaken?
You did in the portfolio for a longer period of time, but let me go up to, I'm scrolling up that page. It's actually pretty far up there. Hold on, I'm just about there. Okay. Here we go. So over the last 12 months, the Chandler portfolio, for instance, returned 3.69 and the internally managed only 1.81. But that's the total return. So a lot of that came from appreciation of the securities that were held as opposed to the yield. The internally managed portion it tends to be very liquid and short term. And so there's less appreciation. There'll be times, and there have been times not that long ago when, as interest rates rise, the longer maturity portfolio that Chandler manages has a lower return than the internally managed portfolio. So it's a give and take, but it's something that I'm willing to put up with.
Well, I was going to say 5-year Treasury on Friday was 43 basis points. So if you're at 52, you're better than 5-year Treasury.
Right.
At this point.
Right. And that's, I don't know if it's a dilemma, but that's what I've been looking at. And it's paid much more handsomely to just roll those maturities into Leif and get a much higher yield than what's available should I reinvest it to other U.S. treasuries or agency paper. Okay, so if there aren't any other questions there, if we go down to page 54, that's the portfolio characteristics broken down. So again, you could see, I guess we were already there, weren't we?
Yeah.
Yeah.
So the next page, page 55, is just a different way of looking at that as far as where we are. Leif went from 52% of the internally managed portfolio to 63%. You may remember that we're limited to 50%, but that's 50% of the consolidated portfolio, not just the internally managed. And on page 56, it just shows the duration distribution, which, because so much is in Leif, looks kind of a little bit crazy. And so if we quickly scroll down to page 57, we take out Leif and any cash deposits, and then we look at the securities held in the accounts, such as the CDs and the treasuries and agency paper. And you can see what the duration distribution is of those, excluding what I would call cash. And then on page 58 is just the issuers and what percentage are in each one. And really, you know, you look at this for a minute, and 100% of the internally managed portfolio is in, you know, government securities, government agencies, or CDs with FDIC insurance, because they're all $250,000 or less. So it's this part of the portfolio is what I would consider extremely safe. Okay, so moving on down to page 60 is the certification page. Nothing much there. And then we go on to, say, page 63, which is the portion, the pension portfolio, which we really don't have any say on, but it's there. One thing you may note, you know, they give the performance of it over the last 12 months. Actually, let's see, they talk about it for the last quarter, I'm sorry. So that was up 10.77%. So it had some healthy returns in it. And you can see its diversification there. A good chunk of it is in equities. And that's why the nice return. They get to use investment vehicles that we can only dream of on the investment advisory committee. But probably those dreams could also quickly turn into nightmares. So I'm okay with that.
Your name is not Bob Citron.
That's right. That's right. Okay. Any other questions on the balance of it? I mean, the rest of it are the reports that the City Finance Department puts together, including the cash flow. I would probably, if you could scroll down to page 66, Jason, that's a good visual on the inflows and outflows of money. And you can see when the blue line is above the red line, that's when the city has net receipts, positive receipts. And conversely, when it goes below the red line, that's when the outflows take place. And that's the time when we spend down LAIF and wait for the receipts to come back in. And then the following pages are just the month by month cash flow reports, both actual and projected. Any other questions there? Or Eric, are there anything of note that in terms of what the cash flow that's coming up? Okay. Any questions by the committee then on the report as presented?
Looks good.
Okay. If there are not any questions.
Choice of agencies over credit is a good choice right now. Not a whole lot you can do, and be safe.
Yeah.
Hang on. Be in lockdown.
I think, Al, you put the words in my mouth. Hang on. That's all we can do, right?
Well, I think in one of Jason's, I think it was on the economic report, really put it in perspective. You know, over the last year, 2-year treasuries went from 1.45% down to 12 basis points. And man.
Well, yeah, a year ago it was 153. And today it's 12.
Yeah.
It's less than 30-day LIBOR. I mean, I can lend higher than that. 1-year treasuries at 6 basis points.
Yeah.
3-month LIBOR, 22 basis points. And, you know, it doesn't seem to be moving.
No.
I mean, 30-year treasuries, yeah, maybe as of Friday, 385 bet or 185 bet. A year ago was 222. I don't know.
Yep, and I think in light of the pandemic and everything, that certainly explains a large part of it. Nor should it be surprising either.
It's concerning. That's what it is.
Right. Yes. Well, do I have a motion to accept the report as presented?
Yes.
Okay, Art, do I have
presented.
a second?
I'll give you a second.
Okay, Al, thank you. All in favor?
Aye.
Aye, aye, aye.
And all opposed?
Any opposed?
No one's opposed. The motion carries. Jason, thank you so much for your presentation and your time with the committee. And also, I just want to thank you again for being available as Steve thanked you for the city council meeting. Appreciate that very much.
Great, and it's nice to see everybody and making sure that everybody's feeling well. And Al, I'm in line with you. When that vaccine comes out, I'm the first one to get that thing. I'm telling you.
You're going to have to wait longer than some of us.
Yes, probably. So, all right. Have a good one. We'll see you guys. Bye-bye now.
See you, Jason.
Bye-bye.
Thanks, Jason. Okay. So next up on the agenda is discussing broker-dealer relationships. I just wanted to put this on the agenda. Next meeting, we'll be looking at the broker-dealer questionnaires and evaluating them. Right now, we'll just have Raymond James that has presented a broker-dealer questionnaire from last year. I was hoping Bill was going to be on this call because he was the person who recommended Wally over at Wells Fargo. And we've tried to get a broker-dealer questionnaire filled out by them, but we haven't been able to. So, I mean, currently we have approved by the committee 3 broker-dealers. The 2 I've been working with, and then Wells Fargo. And in reality, I haven't been using any of them. So I just wanted to, from my standpoint, I'm going to try and get Wells Fargo to fill out the broker-dealer questionnaire so we could evaluate them and Raymond James at our next meeting. But any other thoughts? And let me just add this one last thing. It takes quite a bit of work and time and effort to fill out a broker-dealer questionnaire. So I hesitate to ask firms to do it just for the sake of us having 3 on file to look at our quarterly meeting. I try and ask for them only from the firms that we are likely to do at least some business with. So that's one of my thoughts too. But so from the committee, I guess what I'm asking is, should we be considering any other broker dealers in your minds, or the ones that we have looked at over the past few years, or do you think they're sufficient?
How many broker dealers you need to go to and ask for when you're looking for price checks and stuff? Is that just 2?
Right. Good question, Al. By the investment policy, I need to get 3 prices. So what I've done in the past is I've gone to the 2 brokers that I've been using and gotten quotes from them, asked for them to give them to me at a certain point in time, like 9 a.m. Tuesday morning, so that it's an apples to apples comparison. Of course, getting them to do that at that time is somewhat problematic, from time to time. And then for the 3rd quote, I ask Chandler for the Bloomberg sheets on the security that I'm looking at. So that's how I've done it in the past.
No, okay. So if you have 3, you'd have a backup of, if you couldn't get a hold of somebody.
Right.
You have 3 brokers, and then you can go to Chandler for, so you actually have 4 people, so you're fine.
Well, I'm actually only asking them for 2. I'm asking them for the 2 broker dealers that I've actually used to do business with. Chandler then makes the 3rd quote. The third broker dealer I don't go to. In this case, it's been Wells Fargo because I just don't do business with them. And I don't feel like it's fair to ask them to do work without getting any business. And so that's the way I've been doing it. And keep in mind, I'm getting quotes on, in some, obviously if it's a new issue, it's a moot point. It's a new issue. It's the same price for everyone. But if it's a secondary issue, still it's, they're treasuries or agencies. So it's very, very tight. There's almost no difference.
Mark, is there a fee for these broker dealers? Are they fees the same?
Well, absolutely. I mean, they're in the business of making money, so there's a cost to doing business with them, and that's why we ask for the quotes when I'm out there buying, a secondary issue, for agency paper or something like that. But
Are you finding a big difference in the fees, or are they all pretty standard?
Almost none. Yeah.
Almost no
none.
fee or almost no variation?
Almost no variation. Yeah.
Okay.
So anyway, again, my plan is to get the broker-dealer questionnaire filled out by Raymond James and hopefully Wells Fargo. And then as a committee, we'll evaluate those. We'll get those to you in advance, and we'll evaluate those at next meeting. Okay. All right. The only other thing I wanted before we open it up for public input is the composition of the investment advisory committee. So the last council had studied all the different committees, if you'll remember, and they had passed an ordinance which changed the makeup of the investment advisory committee. It took the council member representative off the committee, added a third citizen representative, and reduced the industry specialist from 2 to 1, which we've only had one for some time since Kathy Dietrich resigned her spot. So when I presented the recommended changes that the committee made to the city council in December, there was some discussion about that. And the city council decided that they wanted to keep a council member representative on the investment advisory committee.
Excellent.
So and I agree. So then when I had to go, they did not, all right, I guess they tabled the investment policy until January. So I went back about, I guess it was last week. And they also had some questions about having foreign securities in the portfolio, which Jason addressed to the council's satisfaction. And they passed the investment policy and a new ordinance so that the council representative remained on the investment advisory committee. So what does this mean to you guys? All your terms have been extended. And as far as I know, Steve, you could correct me if you know anything different. The council will appoint those positions starting this coming June.
That's my understanding. And I see Eric nodding his head, so.
Yep, that's
Okay.
correct. I think we can expect applications. Usually Joanne likes to get the application process out, give or take 2 months before that June timeframe. So there's an opportunity for everyone to fill out their resumes and submit those that are interested in those positions.
Right. And Eric, as I remember, she automatically sends those to existing committee members. Is that true?
That's correct.
Okay. All right. I remember we had someone, his name was Scott, his last name escapes me at the time. And he didn't realize he had to fill out it since he was already on the committee to re-up for his term. And as a result, he wasn't even considered. So I say that if you want to continue on the committee, to remember to fill out the application, that would be great. So other than that, that's all I had to discuss there. Is there any public input?
No, we have no public present.
Okay. Very good. Well, let's see. The next meeting.
April
Courtney, do you
26th.
have-
April 26th.
April 26th. Okay. Very good. Well, I need a motion to adjourn to our next meeting on April 26th at 5:30 p.m.
I'm waiting for
Alex?
someone else. Okay, I will make that move to go home.
Second.
Steve seconds. All in favor?
Aye.
Aye.
Opposed? So moved. Very good. Gentlemen and ladies, thank you so much for your help and participation in this meeting. I look forward to when we can meet face to face again.
That will be nice.
But yeah, that will be nice. My guess is it won't be the next meeting, but until then, if you have any questions, of course, email me or call me. And again, Steve, welcome to the committee. We look forward to having you in the meetings to come.
Thank you, Mark. Thank you all.
Courtney.
Okay.